Get started. To say it's been an interesting start to the new year is a bit of an understatement. However, Danish companies continue to thrive in the United States. Despite the pandemic, last year, Danish exports to the US were up, maintaining its position as Denmark's largest export market, just ahead of Germany. But business remains challenged at many levels. Today, our economic, political, and business experts will discuss what to expect of the US and the global developments in 2021, and hopefully help us make sense of what's going on over there. Today's program features a US economic outlook with Ulrik B. from Berlingske Tidende, a US political outlook with Stefan Kretz from Denmark's Radio, and a look at the business challenges and opportunities with Mark Lucchini, who's the president of Cheney Capital Management. Following the presentations, there'll be a Q&A session with the time that's remaining. So do have your questions and feed them into the chat whenever they come to your mind. With that, let's kick off. To start, I'm pleased to welcome Ulrik B., economics editor of Berlingske Tidende, who's kindly agreed to give us an outlook for the US economy. Ulrik, the screen is yours.
Thank you so much. These are indeed, in many ways, crazy and interesting times. It's always a special challenge as an economist because forecasts this year have been way off because we have never tried this before. And of course, that also goes for what's ahead. Much will depend on the vaccines and how quickly we can resume anything that resembles normal life. That goes without saying in the US, and it goes without saying in the rest of the world as well. In some ways, I'm actually quite optimistic when it comes to the US outlook. If we look at this, you can say that the post-financial crisis upswing of recovery, it's always been with one engine off. Like the consumers were not happy, businesses were not happy, the oil industry was not happy. So you never had the jumbo jet firing on all engines at the same time. And in many ways, 2021, after the pandemic, later in the spring, looks like something that actually could be firing on all cylinders. And that is something that could generate very substantial growth in the US. First and foremost, households are in pretty good shape. Savings rate is high, income has generally recovered, especially medium and high income households have come through this corona crisis pretty unscattered in many ways. Stock market, all-time high, housing prices up. So we are looking at wealth effect is going to be quite positive on top of pretty rock solid financial foundation in the households. Remember that one of the things that's been so unusual in the last 10 years in the US is that households have brought down their debt. That's not something we've seen before. So it's not a super indebted private sector. Businesses have more debt, but especially the household sector is actually looking pretty solid. Second thing, of course, is that we are looking at government stimulus. We had 900 billion come out in December, and we are, of course, expecting much more here in January and February. New President Biden, I have to remember to say it the right way, has proposed a stimulus package of $1,900 billion and not 1.9 trillion. Not all of that is going to go through. This is a lot of stimulus and a lot of democratic priorities or wishes. It really does depend how much of a bipartisan message he wants to send here in the first round, how far he's going to go. If it's up to Bernie Sanders, this is only a down payment on more stimulus. I have serious doubts whether that is going to happen because this is not the last round of stimulus. The next one is waiting in a couple of weeks' time. And that is something I'm quite excited about, a very substantial investment in infrastructure. This is something that Trump could have done 4 years ago, and he would have had very solid democratic backing for it, probably less so from the Republican side, depending on how they're going to finance it. But infrastructure is going to be, I think, a big item in the US. Now, some of that is going to be green, but remember a lot of the things that we talk about as, you say, black or traditional infrastructure has a very large element of green in it as well. Americans waste billions of hours every year in traffic when they're sitting there with their engines humming, waiting. You have a rail infrastructure that's insufficient and run down, which means a lot more goods that need to are transported by road. You have ports that are not able to take the largest ships. Airports, LaGuardia is now being upgraded, so it's no longer in a third world country, but there is a lot of, not right now, but in normal times, even the airports are also under pressure. So a lot of this will actually help to make the US a more efficient society. And I think that is one of the things that's going to be able to sustain growth in the public sector, but in the private sector as well. And it's going to increase the US growth potential. Also on the investment side, I think businesses are going to invest more. You still have very generous write-offs from the tax reform in 2017 when it comes to corporate investments. And I think what we've learned over the last year is that packing a lot of people in a small space is not very Corona conformed. It's something that I think we'll see that people are going to be seen as more of an issue than it used to be. So you're going to see labor productivity increase simply because we are going to have more automation. That was coming anyway because wage cost was going up. So even that is going to improve. And of course, the global economy is also going to pick up speed, probably not as much as the US, but it is going to improve as we all approach something that looks a little bit more normal. And when that happens, we will see US exports also improving. So that is not just the domestic components that are going to generate growth. That, of course, would also lead to a lot more imports. Speaking of imports, green revolution, probably not going to happen, but we are going to see a lot of green investments. I think particularly something like housing renovations is going to be pretty big. It is in the EU as well, because it's fairly easy to do more insulation and stuff like that. It's also something that generates well-paid jobs pretty quickly. So I think that is going to be a big thing when we talk about green on both sides of the Atlantic. But companies that think they're going to export most of these things are going to be quite surprised, because Trump, when he was elected in 2016, a lot of people said it was a mistake. But what we saw in November was when you get more than 74 million votes, considering what's been going on, it's a lot to do with the economic message, with trade policy, being tough on China. And if you go back and look at what Biden has said for a long time, and was also said when he has introduced these aid packages, it's a lot of buy American. So I think businesses can start looking into where they're going to build a headquarters or a factory or start generating US jobs. What we already hear from businesses, there's been an informal pressure where there hasn't been a formal demand. And I think that is going to increase and continue with Biden. So you can say in many ways, trade policies are going to be kinder and gentler in tone, and we're definitely going to see a lot more cooperation between the US and the EU. But when it comes to substance, I think one of the most important measures of success for Biden will actually be an increase in manufacturing jobs. And he's going to go very hard for that. I would say, if you're going to say, how is economic policy going to be for the next 4 years in like very simple terms, whatever works in Scranton, basically think of that. After the financial crisis, the cities, high tech, well-educated, globalized US did really well and generated growth overall. But I think a lot of effort is going to be put into Middle America, both geographically, but also to support the middle class. So there's going to be a lot more regulation of labor markets, focus on increasing minimum wage to $15 an hour on a federal level over a period of time. So that is why I think most Americans will see it in the labor market. You have a new boss in town with a very slim but still a majority in Congress. But it is definitely going to be an economic policy generated towards sustaining and building, expanding the middle class. Yep. I'll stop there for now.
Thanks, Ulrich. A couple of quick questions. Very, very insightful. Thanks for sharing that. So when you see a bit of a boom coming in the U.S. with all the makings of that, what about inflation? Is that a concern in this year?
Any inflation is, I think, is going to be temporary. I belong to a different school of thought where inflation is, in many ways, is given by the global market. It's given by globalization and also competition from technology. So as long as you have these forces present, and you do, I think what could generate inflation in the US would be a substantially weaker dollar. But at the moment, there's really no market-generated inflationary pressures, not in the US or elsewhere. We live in a world that basically non-inflationary, probably a little bit deflationary because of the productivity gains and the expansion of markets that we're seeing at the moment.
Okay. Yeah, that's interesting. And speaking of the dollar, the dollar has reduced significantly in the last 9 months. Do you see that recovering? Because I mean, let's face it, that's one of the biggest threats to Danish companies and their profits is the dollar.
Well, I mean, the easiest thing to believe in a structural way is the collapse of the dollar as reserve currency. And that might happen, but probably not within the next 5 years. I think that since the US is going to recover more than other countries, I do think that the Federal Reserve is not going to be doing what they're doing at the moment for a substantial period of time. I do think once we get into 2022, that actually goes to Europe as well. We're going to see a little bit higher interest rates than currently.
Okay. And do you see the Feds? I mean, I've heard some rumors that they might even be talking up the dollar because I mean Trump was definitely talking it down. So what's your thoughts on that?
I think that central banks have now moved to a different place where they're going to talk. I wouldn't say plaza agreement, but it's obvious you can't have the Federal Reserve talking up the dollar while the European Central Bank is doing everything they can to kill the euro. So you do have to have some balance between the two largest central banks, and they need to have a different compensation than what they had the previous 3 or 4 years. Both central banks need to move away from the extreme monetary policy they have currently. As I said, I do think if policymakers in Frankfurt could choose now, they probably would buy more bonds and not have a negative interest rate. So that is also one of the factors that goes into the whole equation.
You're muted, Steve.
Just to round out this session, Ulrich, you don't have a whole lot of optimism towards the green, recovery, as you would say. You think there's going to be some investments, but what's the outlook for the Danish companies then? I mean, do you think it's just too tough for Biden to sell?
No, I think there's going to be a lot of green. I just think when you talk about the green revolution, as you say, the progressive side of the Democratic Party has advocated. Remember that most of the US is not on the coast. It's not in big cities. You see, the people that, in many ways, you can say that advocate this in Congress come from safe Democratic seats. Suburbs still have a lot of driving. A lot of the US economy is still based on oil. US is the largest oil producer in the world. So I just don't see it as a revolution. I do see it as an evolution, but that's a whole different story. So they know there's going to be a lot of investments in green, a lot of energy production, but the level of sustainable energy production now is pretty low. So I mean, the starting point is low, so you can have very high growth rates and still not outcompete something like natural gas, for instance, which I think is going to be the dominant source of electricity generation energy in the coming years.
Excellent. Ulrich, thank you. Great presentation. Please stay with us so we can do some more Q&A at the end of this session. So now let's move over to Washington, D.C., where we have Stefan Kutz online. He's the chief U.S. correspondent with Denmark's Radio. He's had a busy couple days. Stefan, we look forward to hearing your view on what lies ahead for the Biden administration. So please.
Yeah, thank you so much. Yeah, I have been based here for the past 4 years, but I've actually covered the United States for a great number of years. The first inauguration that I witnessed was in 1993, just standing steps away from President Clinton. In those days, he still had dark hair. So that's a long time I've been following politics, but I've never been to an inauguration like the one that I witnessed yesterday. I'm sure a lot of you followed on TV as well. And what we saw is an illustration of the political landscape in the United States as of today. You probably saw a Capitol under complete lockdown. We had 25,000 national troops here, fences everywhere, no public witnessed the inauguration, huge security. And this was, of course, because it happened on exactly the same steps that were one of the routes that the Trump supporters took when they stormed the Congress just 2 weeks ago. And this all illustrates the current political climate, which after 4 years of Trump's leadership is toxic partisanship. And this is not just in Washington. This is the atmosphere. I've spent the past 4 years traveling, mostly in states that elected Donald Trump, to try to figure out, what is the thinking there? What are the emotions? What are the political aspirations of people who live there? And there was an interesting poll from Axios Ipsos last week. They polled Republican and Democratic voters and independents, and it turned out that Republicans and Democratic voters didn't agree on anything except from one thing. 8 out of 10 from both parties agreed that the United States was falling apart, and it might not be falling apart, but that's the sense that many Americans have when they look at what is going on. So what can Biden do? Of course, today is a new page. It's a new administration, a new president with new priorities. But what can he actually get done? The most important thing, I think, from a Democratic point of view, apart from the party gaining control of the White House, is that they succeeded, the Democratic Party, in gaining control of the Senate. And as you probably know, the political system in the United States is constructed in a way that progress is very slow, with the separation of power. But in order to have some progress, politically speaking, for Biden, it's of extreme importance that he has actually a majority in both chambers. It's very, very slim. It's 50-50, as you probably know, and the Vice President, Kamala Harris, will be the decisive vote in case there's an equality of votes. So it's a very slim majority, but nonetheless, it's very important, because it means that for the Biden administration, they can get their nominees appointed rather quickly. They have a number of things they can do politically speaking, with just a normal majority. For great reforms, they will need a supermajority of 60 senators, which might be difficult. But that's the other interesting story right now is, of course, what happens to the Republican Party? Where are the Republicans heading after 4 years of Trump? And I think we saw a little glimpse of that the other day when the Majority Leader Mitch McConnell, for the first time, pointed his finger at Trump and said, gave him, responsibility for the attack on the Capitol, and told the American people that they had been fed lies about the election. And I think that's probably the beginning of something that's a struggle for the Republican Party to find a new direction after Trump. Because as you have all known, probably you have followed, there has been almost no disagreement with the president in Congress. Never mind what he said or did. Actually, the party was, in a sense, a kind of personality cult. If you didn't agree with the leader, you had to leave. And now that the leader has left, they have to reinvent themselves. But the thing that's very difficult is, of course, they have to figure out where are the voters. And it turns out at this point, 7 out of 10 Republican voters still believe that there was some kind of fraud involved in the election, that Joe Biden is not a legitimate president. And until those numbers start to move, it's going to be very difficult for the leadership of the Republican Party to find a new direction and to sort of let Trump fade out as a leader. So we have two sides of the coin. You have the Democratic Party now in full control of the White House and the two chambers in Congress. We saw a number of presidential decrees in the first hours of the Biden administration yesterday. They had to do with COVID, first of all. This is his primary concern at this point, to get the pandemic under control, to get people vaccinated. He has a program that it's very ambitious, but he intends to have 100 doses of vaccine administered in the first 100 days. And this, of course, has also to do with the economy, to get the economy back on tracks. Then he had a lot of climate initiatives that he signed yesterday. Of course, the Paris Agreement, the US is going to rejoin, but also a number of environmental regulations that had been rolled back by Trump from the Obama years. They were reinstated. And then he signed an immigration reform. This is a huge reform that will take some time and probably a lot of discussion to get it to Senate and to a final vote. But it's a sign that the administration has priorities. First of all, get COVID under control, get the economy started. Climate is a big concern, and then immigration, which was a big promise of the Obama administration, but was never fulfilled. So we see an administration that's active, that has some possibilities because it controls both chambers of Congress. We see a Republican Party that has to come to terms with the fact that the president, the leader that they followed for 4 years, cost them power in the White House and in both chambers of Congress, and they have to reinvent themselves. And this is not going to be easy, because when you travel in like I said, in the red states, Trump is very, very popular. 74 million Republicans voted for him, not just for him, but for the Republican ticket. So it's going to take a little while, I think, for that party to reinvent itself. But bottom line is, you see it's sort of we talk a lot about the United States being divided. I don't really see a divided country right now. I see two nations, really, two nations that have, very, very a difficult time just talking to each other. They can't agree on facts. And I think the tone of the new administration is going to matter a lot, because if you look at just a little bit back in history, the way we viewed the United States under Barack Obama compared to the way we viewed the United States under Trump, it had a lot to do with the tone coming from the Oval Office. And I think the tone that Joe Biden started setting yesterday will probably change a lot of things in the way that we look upon the United States, but we also have to look at the divisions. And this is not a united country right now. This is actually two nations. And the greatest and most challenging thing that the president has to face is how to make Americans, agree on facts and talk to each other. They don't have to agree on which direction to take the country, but they do have to agree on what is truth and what is lie. And I think probably there will be a reckoning for the tech industry in the coming 4 years because of the extreme amount of misinformation that has been spread on social media and the internet over the past 4 years, which in my point of view led to the culmination of the storming of the Capitol. And an interesting little point there is that since Donald Trump was taken off Twitter, the amount of misinformation about election fraud, supposed election fraud, has come down 73%. So that's to my point that the tone from leadership matters a lot, and the ability to spread misinformation matters a lot. And that, and I think the United States is really facing a crisis of democracy right now. If you look at the front page of the New York Times today, the headline is "Democracy has prevailed." That was the point in Biden's inaugural speech yesterday. It has prevailed, yes, but it is in crisis.
Thanks, Stefan. Great thoughts. Thanks for sharing that. And you were front and center as things transpired yesterday. I think we all looked on in a bit of relief that everything went smoothly, and I thought it was a really good speech. But like you say, Europe liked U.S. under Obama, and they're going to like U.S. under Biden. But it doesn't really matter what Europe thinks that doesn't help to mend our nation. So, I was. What are your thoughts on the media's role in keeping America split? The way the media is set up and the structure that and the echo chambers. You said tech, is going to have to come to grips with that, but just the mainstream media is also so slanted. Where do they go with the media? Because I think that plays a huge role in continuing this divide.
Yeah, I agree. If you look at, for instance, cable news, which is both CNN, MSNBC on one side of the spectrum, Fox News on the other side of the spectrum. I mean, they've built a business on politicizing, on being on one side of the fence, on aggravating the split that I was just talking about. And I mean, the incentive is, of course, for businesses like that to keep people enraged, because that makes them engaged. But that's one side of the coin. Of course, the other side is that well-established media companies like the New York Times, for instance, Washington Post, which actually both do great journalism, they have had a tremendous business success under Trump. Because, one very good thing you can say about Trump is he actually made people engaged in politics. You might not like the way that people engage in politics, especially not the people who stormed the Capitol building, but people got very engaged in politics, and that for instance, for the New York Times has meant that the amount of subscribers has exploded, and I don't know how that's going to go now, because if people's interest in politics is dampened because you don't have this constant outrage, maybe people will stop subscribing to well-established media companies, which actually seek to look for truth. So for the media, there's a reckoning too, and I don't know where it's going at this point.
Yeah, I agree. Another point, there's also a question in the chat I want to ask you, kind of combine it with this. There was talk before, now that the Democrats have the majority, or have a majority in the Senate, there was discussions that perhaps it was more palatable for Biden to actually not have the majority, because by not having the majority, he could justify going across the aisle to the Republicans. And now that he has a majority, now the expectations are that he can make things happen.
Yeah.
So, any thoughts on that?
No, it's just that he won with the backing of the full Democratic Party, and now that he won, of course, each fraction of the party will want to cash in on their support for him. So the left flank of the party will try to drag him to the left. Of course, the center part will try to drag him to the center. So I mean, he's going to fight off, people left and right. It's not going to be easy. My point is simply that, in order to be successful, you actually have to get something done. And he actually has a possibility of getting something done right now. And I think it's in the interest of his party as a whole to be able to show that they actually get legislation passed.
Yeah. So just to round out with a couple really quick fire questions, there's, again, about the Democratic Party. We talked about the Republican Party being in tatters, but what about the Republican Party? What about the Democratic Party? Because they're spanning from Bernie, to Biden and everything in between. They don't really have a handle on what their messages are either in reality. So, and then you look at, and then if you go take the next step, my next question would be, what do you see as a candidate for the Republicans or Democrats in 2024?
Yeah, I mean, the Democratic Party, to understand that, you have to understand as an umbrella organization with so many interest groups underneath. And as I said before, they all backed Joe Biden in order to get rid of Donald Trump. I think they probably, most of them, voted to get Trump out of the office, even more than they voted to get Joe Biden into the office. So now they have to figure out, now that they are actually in power, how does he control this big amount of interests that are not, they don't agree on a lot of things. So that's going to be very interesting to follow. I can't answer, I can't see into the future what's going to happen, but it's going to be a challenge for Joe Biden. No, there's no doubt about that. And as for Republican candidates for presidency, I think that's what you asked for in 2024. Oops! Oh my God! Sorry. Yeah, this is a little unprofessional. It's actually I put it here with gaffer tape.
Well, at least you're not hurt.
All right. Let me just do a handheld. I'm sorry about that. So I personally do not expect to see Donald Trump running for office again. I think he would be so preoccupied in the coming years with his lawsuits. Now, of course, first the impeachment, but all the lawsuits against himself and his companies. And I think probably, he's not going to be as interesting for a lot of his followers once he's out of office, once he's off Twitter. So it'd be very difficult for him to capture the headlines. So I actually don't expect to see him run again. I think Mike Pompeo, he has a lot of ambition. He has supported Donald Trump all the way. I think he wants to run for president, and he will create a message that he's sort of a Trumpist, but one you can sort of rely on. Then you have Nikki Haley, who used to be the U.S. ambassador to the UN. She definitely has ambitions as well. You have Ted Cruz, but I'm a little unsure after what happened 2 weeks ago that he actually has the backing of the big donors. So those are three names that I would put in the bag. And as for the Democrats, I think Joe Biden will. If he's well, he'll probably run again, and if not, then of course Kamala Harris will be on the ticket.
But don't you think Kamala has a lot to prove to show she's worthy of being on a ticket? That's for sure.
I absolutely do that, and I didn't really, during the primaries, I didn't put a lot of focus on her because I didn't really think she did very well. So she has to prove herself, and that's not an easy task when you are the vice president, because you will always be in the background. But time will show. Yeah.
And one last, just in rounding out here, one question was, about the appointments on the cabinet being mostly Dems. Biden's been known, and he has done a couple of Republicans, I believe, on his cabinet. Susan Rice, I think, had one appointment. But do you think there's going to be more Republicans coming on his cabinet and the appointments?
I think he will strive to do that. He had an ambition of making his cabinet look like America. And you can't do that with just putting, Democrats in the cabinet. And I think he was swearing in. Maybe you saw that on TV, I don't know, but he was swearing in 1,000 members of his administration yesterday. These are people who do not need Senate appointments. And if you look, I couldn't see how people voted, but it just, all the pictures of these 1,000 people, it looked like America. It was, black, white, brown, female, male, and so on. So I really think his ambition is to have an administration that is not just one-sided, but it looks like America and goes across the aisle, politically speaking.
Great. Kevin, let's stop there, and we'll pick up again on the Q&A. You can let your computer rest for a while and your arm rest. We'll get on to our final speaker. Thanks. Our final speaker is Mark Lucchini, who's been going to tell us a bit about how the U.S. business community is managing through the pandemic and how specific industry sectors are developing. Mark, welcome.
Oh, thank you, Stephen. Good afternoon to everybody. Kind of picking up on some of the things that Ulrich had mentioned too, many of which I'm in agreement with, some of which I perhaps don't see quite eye to eye on, in just in terms of either the timing of the deliverables or perhaps as it relates to certain policies that are being undertaken at the moment, which I think may not expire quite as quickly as what was articulated. But nonetheless, room for debate, I suppose. Certainly, I agree on the point of the U.S. economy being in pretty good shape, especially on a number of fronts. One, obviously, we saw that massive rebound in economic activity in the third quarter of last year, 33%, which at least matched in size, if not necessarily to completely recover the economic output lost in the midst of the lockdowns that were induced by the pandemic in the second quarter. But growth in the fourth quarter remained pretty healthy as well. Right now, the Atlanta Federal Reserve's GDP Now tracker is showing fourth quarter annualized growth running at about 7%. That's not necessarily matched by the New York Fed's version of their nowcast in the fourth quarter, which is posting about 2.5% growth. But the answer probably lies somewhere in between. The point being that while one should have expected a deceleration from the reopening and the pent-up demand release that occurred here in the third quarter this year, is still operating at a sufficiently high level to carry pretty significant momentum here into 2021. The key, of course, was for the so many 13 million or so roughly estimated that are underemployed as a consequence of the industries in which they work. Travel, leisure, and entertainment is only about 10% of US GDP, and yet at the same time, those industries employ 25% of Americans in the labor force. So it's disproportionate in terms of, one, those industries that were most directly affected by lockdowns, especially when you consider a very high proportion of those can't work from home, can't work remotely, are in the services industry, which demand face-to-face related activity. And so as a consequence of that, the importance of the package that was passed in late December that was mentioned of $908 billion was to bridge those individuals and small businesses through the extension of the PPP program to be able to survive or mezzanine for several months the gap that would otherwise occur were the expiration of the CARES Act benefits, which largely started to expire around November, late, early December, which would have caused a diminution of economic activity far worse than what we saw in some of the punkish economic data that came out in the December reports that we're getting now, showing an elevation in the unemployment numbers, the jobless claims that come out on a weekly basis, some of the other services related purchasing manager indice information, the decline in the surveys as it relates to both consumer confidence, taken from a couple of different sources, University of Michigan, Bloomberg, Conference Board, and as well, even in the small business community directly via the National Federation of Independent Business Small Business Optimism Survey, which in the month of December was an oxymoron, given the fact that optimism declined quite dramatically. And importantly, some of the subcomponents of that NFIB report as it related to hiring plans, as it related to the business outlook, and importantly, as it related to CapEx, all deteriorated. And so I think that'll shore up now as a consequence of the new spending package, because once again, it's set to last through about mid-March, March 14th, I think to be precise, which as many have mentioned, including some of our elected officials, that's likely only a down payment on what's likely to be more fiscal stimulus to come. However, I think it's unlikely that we see more fiscal stimulus, at least for some period of time, measured in probably a month or two, if only because of the hesitation on the part of many Republicans to put more money back into fiscal spending, given the enormous increase in our budget and current account deficits in this country. That's going to be a problem at some point, if not necessarily resurrecting itself as one today. And so I think they're going to allow for these benefits to at least start to find their way out into the system before there's more heated talk about, and likely under duress, to do something before they expire in March. And right now, we think that it is likely, if in fact President Biden wants a more bilateral approach to the next fiscal package, that it's going to be one that doesn't match the $1.9 trillion that he's asked for, but rather something probably still significant, perhaps even around that $900 billion, perhaps $1 trillion level. Which will go a long way towards, once again, extending some of the benefits to individuals, small businesses, maybe even to state and local governments. But ultimately, we think that Joe Biden is likely to need the reconciliation effort that's probably not likely to come later in the year, which is going to require actually a majority in the Senate, 60 votes, to pass some of the larger, more expansive efforts to extend fiscal stimulus in the form of infrastructure and otherwise, that'll significantly increase that number in spending above that $1 trillion mark, which ultimately means for the U.S. economy that the kind of growth that right now, that same New York Fed's nowcast is projecting first quarter GDP growth running at 6.2% annualized. That's obviously something that may be running a little hotter than what the actual underlying economy is at the moment, but it's so far at least indicative of the kind of pace that once again is carrying forward from the momentum we had coming out of the end of last year. And we're likely to see, we think, a well above trend growth over the first half, at least, of this year, particularly once again subsidized by the fiscal stimulus that allows for consumption, which drives 70% of economic activity here in the United States, to persist at an elevated level. Once you flip the unemployment rate upside down, you realize there's still about 94% of the labor force that is employed, never lost their job, continue to see wage gains, and for the most part continue to spend at a pretty healthy rate. And when you even consider the underemployed, those that were the beneficiaries of the fiscal transfers that occurred via the CARES Act and now the new fiscal package, that's contributed to the savings rate running today well above what it's trended at over the last decade or so. In fact, it peaked in April to May at 33%, was just literally an all-time historic high in savings rate in this country. It's now been worked down to about 12.9%, but over the last decade, it's averaged about 8% of discretionary disposable income. So there's still powder, if you will, that is available to subsidize those that are either furloughed or underemployed to continue to stay current, as most indicators are with regards to their financial obligations on rents, on payments on credit cards, on payments on autos, on payments on their mortgages. At least through March, with, again, a likely another fiscal stimulus package that enables them to continue to facilitate their financial obligations to remain current until the economy reopens sufficiently concurrent with the rollout of the vaccines that allows those unemployed to be reabsorbed into their jobs that reopen as a consequence of, once again, allowing more mobility around the country, and as well to be able to dine out, travel, experience gatherings at concerts and so on and so forth. But in the meantime, we think job creation will continue to run at a relatively decent pace that allows for a continued drawdown of the unemployment rate, which stands at just under twice what it stood at in February of 2020, which was a 50-year low of 3.5%. I mean, take for instance, December's jobs number that we got the first Friday here of January. It showed that 140,000 jobs were lost in December, although 135,000 jobs were added to the previous 2 months of employment gain. So it was almost a wash. Much was made, though, of the 140,000 jobs that were lost. But if you look inside the labor report, you saw that almost 500,000 jobs were directly related to restaurants and hospitalities. So actually, you had a net gain of almost 400,000 jobs in the month of December. And once again, through the importance of the broad distribution of vaccinations throughout the country, we expect as those industries that have been most directly impacted to reopen, that will consequently be augmentative to the already underlying rate of economic growth that is producing job growth at a rate that's sufficient to continue to allow the country to operate with a growth rate that at a minimum is going to be above trend, which over the last decade was 2.3% annualized GDP growth for the foreseeable future. And we think as a consequence of the pent-up demand that's not been fully released, particularly in the services industry, the manufacturing industry has been running very, very strongly all throughout the pandemic. It's been really the services industry, which is about 85 to 88% of the U.S. economy, that's been most directly impacted. And you can see that in the myriad months of information that has been reported by the ISM, the Institute for Supply Management, or the market purchasing manager indices surveys taken of the services industry. And there's been a quite disparate view of how conditions on the ground are for those businesses relative to their manufacturing counterparts. Now that's starting to recover now, albeit glacially, and we expect that to recover much more aggressively, accelerated in much greater fashion here as we go throughout 2021, which we think is going to lend itself to a growth rate that could actually be 6 or 7% on an annualized basis here sometime in the second half of 2021, which is going to carry momentum well into 2022. So I think, again, from an economic standpoint, my view is very similar to that of Ulrich with regard to what that's going to mean for business activity, which is obviously going to grow in a fashion commensurate with that level of economic activity. And importantly, again, being consumption as a primary driver of economic growth, the continued growth in jobs and the reabsorption of the underemployed into the economy will be a powerful elixir as it relates to consumer spending and how that's distributed throughout the economy as well. So on balance, we're looking once again for a rather sanguine outcome here over the course of the next 12 months. A survey taken by Good Judgment, which polls professional forecasters around when they expect really herd immunity, something north of 70 or 80% of the country to be inoculated to occur. And that's been pushed back a little bit because of the early stumbles in the rollout of the distribution of the vaccines from about the second quarter of this year into the third quarter this year. So they may have only delayed rather than derailed ultimately the reacceleration of economic activity because of the release of pent-up demand that we expect to occur. But nonetheless, we think all in, it will make for a pretty heady growth rate leading into the second half and out through 2022 as well. So what does that mean, though? And I want to speak on rates, and then I'll touch on a couple of sectors. What's it mean for interest rates? Well, we've already seen the breach of a one handle on the 10-year Treasury, which was kind of an important technical level that we hadn't seen for some time. Obviously, we started 2020 with a 10-year yield of 1.92%, but in the midst of the pandemic, that was drawn down to less than 0.5%. And so finishing the year at 92 basis points and now over 1%, I think is indicative of increasing conviction on the part of market participants that this reflationary exercise conducted by both the Federal Reserve and the fiscal impulse and on a global scale on an unprecedented level is beginning to work. We know here alone in this country, We've had on the fiscal side, well over 10% of GDP, in fact, going on 15% with this new package, 15% of GDP basically spent into the economy or will be over the next 12 months or so. And of course, that's matched or exceeded in some cases by countries around the world as well, as is the same script that's been taken by monetary officials. We're here in the United States, we're operating with basically zero bound Fed funds rate, and the Fed has now started to pull back on as a consequence of the Treasury taking back some of the funds that were made available, and in many cases unused, to be extended into the business community to help facilitate their credit conditions or maintain their businesses throughout the pandemic. But that's gone a long way towards curing activity in the credit markets. And so you see spreads on fixed income securities in the credit market over that of Treasury bills, whether you're talking high grade corporate bonds or even high yield corporate bonds, now compress the levels last seen prior to the pandemic. So obviously, any kind of stress that we saw here in the early stages of the pandemic has been evaporated as a consequence of not only the recovery of the economy, but as well the Fed's backstop, if you will. It's whatever it take methodology with regard to its policies. We don't expect the Fed to move off of that zero bound interest rate for the foreseeable future. Their new mandate of average inflation targeting, coupled with their commitment to seeing maximum unemployment, which implicitly implies at least an unemployment rate below 4.5%, suggests to us that we're going to continue to see short-term interest rates buried at or close to 0% and real rates negative for at least the next couple of years. So what that means for investors is they'll continue to struggle, although for corporations, they'll be able to feed at the trough of low interest rates or low costs of capital for borrowing needs at very low rates for the foreseeable future, even as the yield curve is steepened somewhat. And for equity investors, the rager that's underway by way of FOMO, of fear of missing out, we think is likely to continue. Sector impact under the policies of the new administration, I think, will be most directly felt in the energy and healthcare sectors. There is bipartisan support for drug price control, so we view large pharmaceuticals as being under some stress there in terms of addressing how they're going to replace the profitability of some of these drugs if they're negotiated to different levels than what they've been accustomed to, let alone passing along price increases that they're notorious for. In addition to that, energy is obviously going to be affected by things like we saw yesterday under executive order, which was the discontinuation of the Keystone Pipeline, no drilling on federal lands, and other things to disincent fossil fuel activity to the benefit of clean energy and alternative sources of energy like electric vehicles and so on. On the other hand, a sector that's likely to benefit is industrials and even maybe to some degree basic materials as a consequence of where, again, there's bipartisan support, although there's differences in definition around what is infrastructure, but nonetheless, an infrastructure spending package we think is highly likely, which again is going to befall to those industrial type of companies that are going to be right front and center of the direct related activity to building bridges and roads. And I think also the consumer discretionary sector, not all of it, but certainly parts of it that are going to benefit from, again, the strength of the consumer, which is remarkable given the fact that we had a pandemic. There's still so many underemployed, and yet as a consequence of the rally in stocks and the housing market, household net worth today at $123 trillion is double that of its last peak prior to the great financial crisis in 2007. Debt as a percentage of disposable income is the lowest in a generation. And in addition to that, the service cost of that debt is the lowest in 50 years, given where interest rates are. So households are really in good shape relative to the prospects of the powder that's dry to be able to continue to consume at an elevated pace. So we like the consumer discretionary sector. Two other sectors that may come under some duress: technology and communications. Communications, of course, is dominated by Facebook and Alphabet. The technology sector speaks for itself, and some of the behemoths, some of the monolithic companies that dominate those sectors have come under increased scrutiny with regard to antitrust behavior, the 230 Act with regard to posting content on their platforms. And so we look for that, coupled with the fact that a steeper yield curve and higher interest rates is counterweight to long duration assets from a valuation standpoint. And the valuations that are currently being supported within some of those companies are quite high, maybe in some cases egregiously high, and only rationalized under a disinflationary low interest rate environment that we think this regime change that we're seeing here, economically, fiscally, and monetarily supported, is likely to change. So with that, Stephen, I'm going to conclude my comments and kick it back to you.
Thanks, Mark. And that was a lot of numbers you threw at us, so we're going to have to take some time to absorb that. But just a quick question: how do you feel about with the stimulus packages and the debt levels of national debt? Does that concern you?
It does, in the consequence, in terms of the consequences that there's going to be a price to pay. The question is at what point, and this has been a source of debate for the last 10 years plus, and it's not so much so under the conditions that the modern monetary theorists would lead you to believe, which is to say, as long as you have your own currency and a printing press, which we do in the form of the Federal Reserve, we can afford higher levels of debt. In fact, you saw perhaps, or some of you may have seen comments related to Janet Yellen's testimony for her nomination for Treasury Secretary, which was basically to argue for now is the time to act big, which is to say, in this interest rate environment, we can afford to take on more debt because the service cost of that debt is so exceedingly low. Well, that works until it doesn't, and the doesn't would come in the form of the bond vigilantes perhaps arising and demanding more interest in the terms of what they're paid for to continue to borrow money at such egregiously low interest rates when compared to the level of indebtedness that has us on the path of Greece at 100% to GDP. So there's that debate going on at the moment, but I don't think it's a concern, again, given the fact that, again, the interest cost is about 1.7% on a weighted average cost of capital. And our auctions generally have gone off pretty smoothly, although I think one has to be cognizant and sympathetic for the view that you see the stockpiling of gold by China, Russia. You see basically overt efforts on the part of other countries, even in Europe, talking about not wanting to be beholden to the crosses that they have against the U.S. dollar when the U.S. government and the consequences of the market behavior of market participants in the dollar has a lot to do with impacting and infecting some of the policy moves or limitations they have as a country as they try to manage around the volatility in their currencies.
Thank you. Excellent. Well, let's use this to move right into the Q&A session. We still have some time for a couple questions here. Please continue to post those in the chat. Ulrich, you're still with us? I hope.
I am. I just removed myself.
No, that's good. But I do think Stefan Kletz had to go to a radio interview, so it'll just be the two of you. Ulrich, some comments on thoughts on where you disagree on the economy. Any thoughts on that? And then I also want to ask a general question to both of you about about the transatlantic relationship. So Ulrich, any thoughts on rebuttal to Mark?
Yeah, I wasn't really sure where we disagreed all that much. I think it may be a little bit up on timing. I do think that a lot of right now, I think as a Dane, we have a tendency when we see things coming out of Washington. We have a new president, apparently has a majority in Congress. It's going to happen quickly. Very little happens quickly in DC. So never confuse wishes with action. And that's all. 1.9 trillion. It's not going to happen, but I do think elements of it's going to happen. I still think, especially the aid to states, cities, is one of the things that's quite important because they're really hurting. And that is where I think a lot of money will go. That's the one area that has not received anything, or not very much, because of Trump. I'm not so convinced about the check. Maybe Mark can come back into that. That the giving out $2,000 or $1,400 extra on top of what was handed out in December, it's not a very smart way of doing stimulus, because as Mark has pointed out as well, most American households are doing well. So handing that out to people probably just end up in savings, and then you have an even bigger debt and not very much to show for it. So it's much better to target it at businesses and those who are affected by unemployment, and as I said, to cities and municipalities. So that's what I would expect. But generally, I do think I think Biden is going to be lucky in some ways. There's no plan for vaccinations, right? So in that way, you say, can he do better than Trump? I mean, he can't do worse. So even though might take him a couple of more weeks, because he starts not from 0 but from -10, he first has to figure out what the mess is. I do think once you're up and running and once you see this works, do think you'll see an increase in consumer confidence. And that is also people will not spend money. And same in Denmark. I think everybody's going to wait because we want to go out. We want to travel. We want to do all the things we can't do. So why buy more goods from China? Why not wait a little bit and then run screaming with bubbles in your hands? I think that's the way forward for everybody.
Thanks, Ulrich. Any thoughts on that, Mark?
No, I agree. Obviously, even a Democratic senator from West Virginia, Joe Manchin, has agreed that he would prefer a more targeted approach because of what Ulrich said. I see, frankly, on a personal level, I have 4 children. They're all gainfully employed, actually doing quite well. And I don't want to say the last thing they need is another $1,400, but at the same time, the last thing they need is another $1,400, particularly from me. So I would concur with that sentiment for sure. And I think that is a source of debate around the next fiscal package and how it needs to be streamlined to be more directed and effective on those affected areas than necessarily just a blunter approach to distributing a lot of money. Separately, though, on a different issue, where I push back on some is this notion of inflation. And I know you brought it up as a question, Stephen, before. And my pushback on it is just to be more open-minded about its prospects, because those obviously are correct in stating that we had a lot of stimulus back in the aftermath of the great financial crisis and it generated no inflation. Why now? And the difference is that in the great financial crisis, that was a balance sheet recession. Money went into the banking system, and that's where it went to die, because the banks needed to restore their balance sheets because many of them were on the verge of obviously collapse. And in fact, some of them obviously did. This time around is an income statement recession. So given the fact that banks were in amazingly strong shape in the US going into this, they're over-endowed at the moment. In fact, you see in these last quarterly earnings reports, they're releasing loan loss provisions back into earnings, making available more money for lending, capital repurchases, or increasing dividends. And so that's a really bullish signal. That's a good story. But what it also means is that a massive amount of liquidity that's hit this economy, it's running at 24% on an annualized pace. That's unprecedented. That money is making its way into a well-endowed economy. If demand starts to pick up, and you can see it through a factor known as the velocity of money. If you look at the velocity of money, which is basically nosedived over the last 10 years or so, it's starting to hook up, albeit nascent at this, not so ready to declare it any more than noise, not necessarily signal, but it's certainly directionally encouraging. And if that starts to pick up, that churn of money could start to create and engender a more inflationary. I'm not talking about hyperinflation. I'm just talking something above the 1.5 that the Fed has struggled with for seemingly forever at this juncture, and could exceed their 2.5% average inflation targeting rate for some time, which again, may not threaten anything. It just should, I think, demand that investors and businesses think a little bit differently about what might be the prospects for cost of capital, for pricing power, for input costs, and from an investor standpoint, how to invest in a higher interest rate or inflationary regime than what we've experienced, and what are better protected virtues in the market to defend loss of purchasing power due to rising prices through the form of inflation that we haven't had to think about in many, many years. In fact, directly from an interest rate environment, haven't had to think about in 40 years since Paul Volcker stepped on inflation in 1981 and basically killed it.
Interesting. Thanks for that. Ulrich, one last question to you. We're running a bit short on time, but I talked a little bit about in the start about how Europe loved Biden, and Europe's going to love Obama, and Europe's going to love Biden. So, but when you get right down to it, what does Europe have to offer Biden? That's what I often ask the question, because are we really, because we're so slow at moving and really coming out with something concrete? What's your thoughts for the transatlantic relationship? Where we are now, are we going to have something to offer?
As I said, the tone is going to be kinder and gentler. But I do think what you saw the European Union make an investment deal with China 3 weeks before Biden coming in. And that was what Biden really wanted from Europe, was a united front in the discussions with China, because we completely agree. But I do think in many ways, we are going to like Biden because he's a likable guy. But I don't think that, I think this election in November was, to many, I think to Europeans, more of a wake-up call than 2016. 2016, there's still the Russia thing, that Clinton was a bad candidate, blah, 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 no one knew Trump. But this election reflects that the US is not what the US used to be. Or rather, we didn't know what the US was. And as I said, the whole idea that globalization is just going to be a great thing for everybody, we know it's not true. We just didn't care about the losers. And the losers are now driving US policy. So in many ways, we're going to be a little bit, we say, it's not that we don't trust each other. We just have to feel each other out a little bit. And I'm not so sure that our interests are always as aligned as they have been. And remember, Europe has been extremely active on trade front over the past 4 years. Now, we have made trade deals that are just, it's astonishing. Not just Japan, Canada, Singapore. We have a political deal with South America that might be moving forward if we can get the Brazilians to stop cutting down and burning the rainforest. We have a pipeline to Africa. So where Trump has withdrawn, Europe has stepped in and stepped up. And the question is, where do we belong together across the Atlantic in that new world where we are trying to forge a way in between China and the US? And I'm not sure where that ends, but I don't think we have the trust that we used to have, because we realized in Europe that the US is different than we thought it was.
That doesn't sound like you're too optimistic for a revamping of some kind of a TTIP.
I don't think so. No.
Mark, any thoughts on trade from your side when you just take your global glasses on?
Well, I agree with Ulrich in the sense that I think what we had in President Trump, which did some good things and some things that were debatable, was yet a mercantilist president. He was very transactional, and I think very effective in some ways, in particularly interfacing with China, and less so in other ways, particularly as it relates to our allies, particularly in Europe. I think obviously not to say Joe Biden's going to be soft on trade, but I think at the same time he's going to be take a much more multilateral approach. and try to restore some of those relationships. I think to Ulrich's point, it'll take time to build that trust back, but I think directionally is going to go a long way. I think that's going to help measures under Baker-Bloom, like the Global Uncertainty Index, decline, which is actually going to help to weaken the dollar, quite frankly, and be good for our export activity, which is a whole other discussion related to the strength in the euro. But that all said, I think I look very favorably on Trump, or that is Biden and his administration, on helping to restore global trade. It peaked in 2010. Globalization is not going to reaccelerate, but it could perhaps stop deteriorating.
Interesting. Good. Then we're running out of time, like I said, but I think I'll just ask, just to sum it up, any final remarks? For example, just thoughts on what do you see as the biggest threats? What keeps you guys up at night? Ulrich, can you share it with us?
Let's put it this way. I'm not too worried. As an economist, I'm not too worried about the US in the short run. I'm much more worried about Southern Europe than I am about the US, which the Southern Europe has managed to disappear in Brexit and Trump noise. But we're coming back to that. It's going to be dreadful later on this year. So that's really my big issue. And then I have to say China again. What are we going to do? And are we going to get a mutually respectful coexistence, or is it going to be this weird passive-aggressive thing we're doing at the moment, which is not benefiting anyone?
Mark?
I guess from an endogenous standpoint, it would be the threat that we see higher interest rates and/or inflation emerge quicker than expected, and a hawkish turn by the Federal Reserve would upend risk assets that are poised to not hear that news anytime soon. I think as it relates to exogenous risks, I agree. For me, it's China. Their strive toward achieving hegemonic superiority vis-a-vis the U.S. Is not going backwards anytime soon. And the only question is, how does it manifest, particularly as it relates to Taiwan, which I think is a military concern, a militaristic threat, if you will, at the moment. And so I would agree there that from that standpoint, that's the one that isn't going to go away. And in fact, I like Ulrich's phrase, the passive aggressive approach, I think is going to come to a head at some point. It's just a function of when, not if.
Excellent. Well, with that, Mark, thank you. We're out of time. So let me just quickly round out this session. It has been a most interesting and relevant discussion. I want to thank both Ulrich and Mark and Stefan, who's not with us anymore, but the three of you for sharing your unique insight with us today. It's been a real roller coaster in a way, but very insightful. So that wraps up what we have for you today. Thanks for staying with us. Just some parting thoughts with AmCham. With a new U.S. administration in place and the prospect of the appointment of a new U.S. ambassador here in this year, 2021 is shaping up to be a very busy year for AmCham. So we do look forward to seeing you again at upcoming AmCham webinars and hopefully in person in the not so distant future. With that, thanks for joining, stay safe, and have a great year.